Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. And welcome back to Cash Talk. And today I'm joined by JK. JK, how are you, mate?
Good, thanks, mate. How are you?
Yeah, not bad at all. Buzzing off a few coffees today, so hopefully read them as usual. Starting to think I survive off caffeine. But anyway, that's it. How you been, mate? Been up to much?
Yeah, good, mate. Always something going on. So
we're post end of financial year. Is things settling down for you, or
settling down? I kind of describe the end of financial year as chaos that you kind of would rather not have. Let's put it that way. Yeah. So I think the level of busyness is still there, but it's a different kind of busy and more good busy than bad busy. Let's call it.
Yeah, understand. Now, JK, we get a lot of queries in regards to self-managed super funds. It's been something that I've been constantly educating people about. It's something that people look towards. It's becoming quite common lingo with people around, do I get an SMSF? I want to get an SMSF, or do they have an SMSF? So, JK, because there's a lot of misconceptions of actually what a self-managed super fund is, what is it?
So to put it simply, it's pretty much a super fund that you set up yourself. So you establish the fund, and then that enables you to have a little bit more flexibility in regards to the types of investments you can invest in that you may not be able to access through like a normal super fund, let's call it.
Mm-hmm. So it's essentially an entity which can house assets, and because it's a superannuation fund, it's got these superannuation tax considerations and laws that govern that retirement vehicle.
Correct. Yeah.
But ultimately, it's a trust, isn't it?
Correct. Yeah.
Yeah. It's just a trust with certain provisions that are on it.
Correct. Yeah.
Cool. So, JK, in your opinion, and this is very wide-reaching, what are some scenarios where it can be suitable for someone to maybe look at exploring a self-managed super fund?
Yeah, so there's a few that come to mind. The biggest one is around people wanting to purchase commercial property within the SMSF. So that's a big one, especially for people that are self-employed and they potentially want to buy like the business premises within their SMSF, and then obviously still paying rent and that sort of stuff, but they're able to essentially in a way like pay rent to their future self as opposed to someone else. And it's also lets them use those funds to be able to facilitate that if they don't have funds elsewhere. So that's probably the one I think that we see the most. The other one is around wanting to borrow to invest in your super. So that's very hard to do in sort of a normal or ordinary super fund. But having that SMSF there enables you to do that. However, in saying that, I can't think of too many scenarios where that would actually be worthwhile.
If you've got the right strategy.
Correct.
Yeah. So it's a lot of people that are property orientated. You need to use leverage. And you're using it to hold entities where you get tax considerations.
Correct.
And you're building up this kind of, hopefully, this tax-free asset when you retire. Now, there's obviously, not obviously, but it does become more appealing when you've got bigger balances.
Correct, yeah.
And why is that the case, JK?
Because they are quite expensive to administer. Because now what you've got to do is you've got to do all the accounting for the SMSF yourself.
So like the tax returns, the member statements, the financials. Yep.
It's also got to go off to auditors to get audited. So then there's another cost involved.
And the auditors are making sure the thing is compliant in line with superannuation laws. So we're making sure that there's no arm's length transactions. And do you want to explain that, just a quick one? Because this is another one where people get mixed up. What is that?
So essentially the arm's length transaction rule is just to basically say that, for example, that commercial property example, if you're a business owner and you want to buy commercial property, the SMSF essentially has to rent it to you on an arm's length basis.
Yeah.
And what that means is it essentially needs to be at market rates. You can't do yourself any favors and give yourself a discount, or you can't, make it more expensive as a way to channel more money into your super. So that's pretty much what it means, doing it at market rates.
And there's also little intricacies around, like, you can't kind of go in there and paint the property yourself. Like, as in, what I mean by that is, and that might be a poor example, but they don't want you kind of influencing that investment.
Correct.
Yeah. They want this to be a retirement vehicle that is separate to influence. Yeah. And there's a lot of rules and regulations in regards to that. So, going back to bigger balances, so it becomes more affordable.
Yeah.
You've got the accountant involved doing the financials, member statements, financial statements, tax returns. You've got the auditor. Then you've also got sometimes financial advisor coming involved. Yeah, in most cases because of the investment strategy.
Yep.
And what's the investment strategy, JK? And what does the government want with this investment strategy?
Yeah, so the government essentially wants there to be a process in regards to, well, let me take a step back first. As trustee of that super fund, you're now essentially responsible for the decisions of the SMSF.
With the purpose of meeting the superannuation laws, which is this vehicle is for retirement purposes.
Correct.
Yep.
Correct. So what the ATO want to see is that you've essentially got the processes in place for developing what they call an investment strategy for the SMSF. So it's not that you're just going, oh, let's whack it, $300,000 into this investment. There's an actual methodology in regards to how you're coming up with those decisions.
And linked to a specific goal. So you'd spend a bit of time, I know I do it, and you've done it with me multiple times, around making sure that the investment strategy is in line with the goals and aspirations. So is this something that needs to be updated regular? Like,
It's something that it needs to be reviewed regularly, but it doesn't necessarily need to be updated all the time. As long as it's reviewed and it continues to remain appropriate, then there's no specific need to go off and necessarily do a new one if the strategy is still in line with the goals of the members and the strategy that we want to have for that SMSF.
So one common thing that we get is around, if you've been given a statement of advice or given a financial plan, do you need to have an investment strategy, or is the statement of advice and financial plan the actual investment strategy?
Yeah, that's a good question. So you still need an investment strategy, because essentially the statement of advice is our advice to the trustees, but it's still not, at the end of the day, the strategy that the trustees have adopted within the SMSF.
So it's a separate thing.
Correct.
Now, when we talk about it becoming more beneficial for larger balances, the government's came out and gave recommended levels, okay, roughly about $500,000 in funds. However, it's an indicator, but when you take into consideration costs, taxes, so on and so forth, and then you weigh them up in regards to maybe a normal retail or industry super fund, it's hard to justify a self-managed super fund even at 500,000, isn't it?
Correct. And personally, for me, the biggest reason for that, and a lot of people don't consider this, they just look at the dollars aspect of it. But let's just say, for argument's sake, it's going to be the same cost to run an SMSF as it is going to be to have a retail super fund.
Yep. So you've done a comparison between the two, exactly the same, yeah?
Correct. You've also got to consider as trustees, you've got the time involved for you to do all that administration, which is worth something. Then you've also got the legal responsibility that's associated with that as well. So essentially, as trustees of that SMSF, if anything goes wrong, you're essentially liable under the SIS Act and essentially the ATO can impose penalties on you for any sort of wrongdoing or misconduct or anything like that.
And they're quite hefty.
Yeah.
Yeah. And this is the thing, like, do you want to be able to sleep at night? Yeah. And I think it's a more of a naive thing about people just not knowing.
Yeah,
and
a lot of people don't know that.
Yeah, and it is, like, self-managed super fund has become a spin-off to get people, have a self-managed super fund. It's something to become a little bit of a trend, and we've probably had to kind of wind down more than we had to kind of set up for the fact that most of them are set up incorrectly. And, most of them are set up with, I want to buy property or I wanted to buy something, and then it never eventuates, they never execute on it. And then it's like, why'd you do it in the first place?
Yeah.
And we have some clients with millions of dollars in normal retail or industry funds doing what they require to be done, and they don't need a self-managed super fund because of that exact thing. Is they don't want the stress, they don't want the the risks that are associated with it.
Correct.
And from a cost-benefit analysis, the retail funds and the industry funds have become much more competitive on those higher balances, capping out a lot of their admin fees for those higher balances.
Yeah, correct. Spot on. The other thing that I was going to mention too is just around the access to the particular investments. A lot of people think that if I want to go buy something a little bit that's more, direct, like for example, direct Australian shares, you may not be able to do that in, say, an industry super fund. There's some that allow you to do it, but there's also what we call wrap accounts as well, which are they give us a lot of access to different investment options. Not to the same level of an SMSF, like you're not able to buy cryptocurrencies or that sort of stuff in there, but it does have a lot more flexibility than what people think. So even for certain things that they want to do, they can still use a retail super fund and they don't need an SMSF.
Yeah, so regarding that control element,
Yeah.
a lot of people say that, and this is getting, not a lot, but some people say ultimately there's a custodian
Yeah.
that sits in these retail funds, and they don't want that to be the case. They want to be in control. I would argue it's probably, and they do it from a safety perspective.
Yeah.
I would probably argue, JK, that it's safer to have a custodian than it is to have it in a self-managed super fund. Would you agree?
Yeah, I think so too. And the way they structure those custodians from a legal perspective, it's essentially the money's your balance or your benefit and your assets are kept separate to the operating activities of that super fund. So let's just use the example that the super fund was or the company administering that super fund was to go under. Your benefits as a member are still protected. Like they can't be used for, liquidation or anything like that. And then another sort of super fund or administrator will then just take over the administration of those assets. And then you can choose what you want to do. Do you want to stick with it? Do you want to roll it over to another fund? What does that look like?
So you're more concerned about the actual underlying investment where your money is actually held.
Correct.
Be a Vanguard, BlackRock,
Correct.
particular direct company, whatever it's going to be. You're more concerned about that. And even like Vanguard and BlackRock, who are mainly ETFs, it's around the actual direct holdings that sit within those managed funds or in those ETFs.
Correct.
That you're more concerned about. Correct. B, like let's use Qantas, for example. If Qantas goes under and you're a shareholder in Qantas, do they have a buyout or not a buyout, or are you going to lose everything? That's what you're more concerned about.
Correct.
And I think sometimes too much control for someone who doesn't know what it's like taking off the safety features in regards to a car.
Yep.
Yeah, it's like
100%.
You've taken out the airbags and you might go faster.
Yeah,
but you probably need those airbags.
Yeah,
and you need those blind spot monitoring, and you need all of that to ensure that you don't have an accident. So, it's not to say though where self-managed super funds are not for everyone.
Yep.
They do hold a place. Like, we've got a client with a significant level like balance, and there's some pretty cool things we can do when you got large balances. You've got intergenerational wealth. That are very important. Yeah. And so I think that bar of 500,000 is it's in my opinion, it's one of the criteria and it's probably on the low end.
Yeah, I agree. Yeah, I think it's definitely more of a guide. And in our experience, where we're saying, well, even do we keep an SMSF or do we wind it up? It's usually either, now that I'm thinking about them, the balances are at least $1 million.
Yeah.
And you've also normally got like a direct property or something in there. Or there might be like unrealized capital gains or carry forward losses you don't want to give up, that sort of thing.
So where have you seen them go wrong, JK?
Yeah, that's an interesting one. So
like some war stories.
Yeah. Couple of things come to mind. One is around the accounting and the tax reporting and all that you got to do at the end of the financial year. Essentially, and sometimes this isn't the fault of the trustee. Like in this scenario, it was actually the accountant's wrongdoing, essentially, where we went back and noticed that contributions weren't claimed as tax deductions when they put money in, because normally with a retail super fund, you'd submit a notice of intent to claim. They've got their process that they go through. But essentially, this was just a transaction on the bank statement. It was labelled as a contribution, but the accountant forgot to claim it. And it went back, I think, 3 or 4 years, so we couldn't go back and amend the returns or anything like that. And there was also a rollover out of that SMSF that had taken place as well.
Which then voids a portion of the contributions that were made.
Correct. So how the auditors didn't pick that up, I'm not sure in that scenario. But it is one of those ones where, would that have happened in a retail fund? I can't see that having happened if they weren't in the SMSF.
So it's the fault of the auditor, it's the fault of the accountant, but ultimately who's at fault?
Well, ultimately the trustee's at fault. But also too, like you can look at that client and say, well, you know, it's the accountant should have done their job properly. But regardless of who did in the wrong, it was still the client that was at the detriment.
Yes.
So that in itself was not worth the risk, and definitely if they were saving anything from the SMSF, well, they lost pretty much all those savings anyway.
Yeah. There's also another one we're winding up at the moment where so much time was involved.
Yeah, heaps.
Just transactions, doing everything. They originally spoke to an accountant set up a self-managed super fund, advisor set up a portfolio.
Yeah.
Large levels were sitting in cash, and these people are extremely time poor, working for 2 IT companies. And it's like the only ones winning out of that scenario was the accountant and the financial advisor. And the client was not winning in that.
Yeah, 100%.
And now actually to unwind a lot of those things, and there was capital gains that we've had to mitigate, and ultimately we want to move them into a low-cost kind of arrangement with no worries. It's been an absolute headache, hasn't it?
Yeah, that's been a massive headache. And the other one that's, apart from what you've just mentioned, in that scenario too, which a lot of people forget, is when it comes to setting up insurances, depending on how you set up the insurances
In the first place.
and how they're owned by the SMSF, if you then need to wind up the SMSF for whatever reason and your health has changed, or there's even legislative changes where that type of insurance product is no longer available, it can mean that when you wind up the SMSF, you actually lose those benefits of that policy. Now, depending on your scenario, you've got to consider, well, is it maybe worth keeping the SMSF to retain those benefits, or do you still wind up the benefits and take on an inferior policy? That's depending on the situation. But it's important to be aware of how insurances can play into that as well.
And so in some cases, you can change the ownership of the policy and not have impacts on the actual policy itself.
Yep.
However, that is not for every insurer
Correct.
on every policy.
Correct.
And in this case, they happen to be in one of those policies where they have to revert to a new policy,
Correct.
which is going to be inferior to their previous policy.
Correct.
Now, they don't need to go through medical underwriting, I'm pretty sure, in this case. They don't, but they are going to get a wash-down policy.
Correct.
So they're going to lose benefits.
Correct.
Sometimes I wonder if it's worth it for most people, And it can be a very good vehicle.
Yeah.
Like I've seen a lot of business owners use it very, very well. I've seen a lot of affluent people, but for Middle Australia, in most cases I see them not utilised correctly. And so, you know, today I wanted to really get you on, JK, to unravel some of the pros and cons for this. And for people to be aware that it's not this kind of gravy train system where you grab this and, you know, a lot of the thing at the moment, JK, has been around using your self-managed super fund to go buy a property. And it's quite concerning what I see because in most cases it costs an arm and a leg to set up. The lending costs more inside than it does outside. Usually the person that's encouraging that is conflicted.
Yep.
It's the property kind of guru. It's the mortgage broker. It's the whatever. And they're making more money than the person is. Once you do the net benefit of the person, it's like, why'd they set up the self-managed super fund in the first place? And then it's most likely it's because they want to get into property, and then looking at their overall asset allocation, and then they've got like 99% in property and no diversification anywhere else. And they're making the diversification problem even worse because we don't want to make sure all of our eggs in one basket. And then you speak to them and you're like, you don't want all your eggs in one basket? Yeah, or I don't. But then they're making decisions not on the premise of reducing risk.
Yeah.
And so be very, very careful what you do with your retirement savings.
Correct.
Because if you're 3 degrees off course, you're retiring 15 years later, or if you're not retiring 15 years later, you're living a life in retirement That is not what you expected.
Yeah, 100%. And like our investment philosophy, which I think is quite simple, we try not to make things too complex. Having an SMSF, and I think the reason why people get, caught up in that whole, I should go set up an SMSF, is they think when it comes to, building wealth, you got to be fancy with it. And, it's supposed to, we use the term sexy. It most of the time doesn't need to be. And it's usually worse if you go down that path of trying to make it complex.
Yeah, 100%. Now, don't get me wrong, guys. The SMSFs do have a place for unique people. Trusts, companies, entities do. However, you need to do analysis to make sure that these are right.
Yeah.
Got to surround yourself with the right accountant, right wealth advisor, right legal team, auditors. We talked about that. And then come up with a plan that is ultimately to benefit you.
Yeah.
Not to benefit anyone else, to benefit you. Yeah. And with the regulation that I'm seeing around SMSFs, this self-managed has become now more reliant on accountants, auditors, financial advisors that it's not self-managed.
Correct, yeah.
So hopefully today's episode has been really informative. And if you've enjoyed it, please subscribe to our YouTube channel. And if you're liking these on our podcast platforms like Spotify and whatnot, please follow us and share this with every person you know. JK, thanks for joining us.
Thanks, mate. Thanks, everyone.